Let's get to Jay Taylor, President and CEO of Taylor Hard Money Associates, joining us live out of New York. Jay, good morning or good evening your side. Good to see you. You think gold should be a core asset in all portfolios during crisis periods. Explain why.
Well, gold is basically retains its purchasing power where currencies do not, and we're seeing that it's a very, very simple matter of supply and demand. When you increase the supply of a currency or any commodity, as we are now, to try to finance the deficits and bail out banking institutions, what have you, when they create money out of thin air, in essence, is what they're doing with paper money, the price, the value of that unit of currency has to go down. And gold increases in value. We just heard the Newmont mining story, how they're producing gold. But it's very, very difficult to produce gold in any kind of quantities, anything like what they're producing in terms of money, the creation of money. After all, these days, all they really have to do is some keystrokes of a computer to increase the money supply. And they're doing it at a torrid pace. So it's not that gold is gaining in value. It's that currencies are losing value, and they're losing value very, very rapidly.
Jay, how strong is this bull run? And as far as the outlook is concerned, is it possible to revisit the inflation-adjusted peak that we saw during the 80s of over $2,000 an ounce? Is that realistic?
Oh, absolutely. I think that until central banks provide a signal that they're going to be responsible in terms of defending the value of their currency, that you're going to see gold rise to unlimited levels. I mean, who's to say how high gold can go? So, you know, the $2,000 or so is sort of an inflation-adjusted value for gold from the peak in 1980 when gold hit $850 an ounce. But I can recall back at that time, $850, I mean, there was a lot of fear in the markets. We had double-digit inflation. There was a loss of confidence. In some ways, the U.S. was in a depression then. In fact, if you looked at the inflation-adjusted decline in the Dow Jones during the 1980s, during the 1970s and into 1980, early 80s, it was worse, or it was almost as bad as the 1930s if you take into account inflation. So we had inflation, we had high levels of unemployment. So we haven't had the inflation problem yet. And if we start getting higher levels of inflation, I think you're going to see the bright...
I've got to say, though, a lot of people have been jumping on the gold bandwagon. It does look like a very overextended, crowded trade at the moment. You've even got Harrods in London selling gold ingots to people. Is there a bear case to be made for gold, especially when physical demand remains very soft?
Well, I don't know that physical demand maybe for jewelry remains soft, but remember, it isn't jewelry that drives the price of gold. What drives the price of gold is demand for holding it as a monetary unit. I mean, gold actually, when the price of gold rises, the jewelry offtake is lower. What's driving this gold price is banks like the Indian Central Bank buying gold. It's large investors buying gold. I mean, we're seeing HSBC is telling the small gold holders to get out. They need room for their large institutions, and I'm hearing more and more evidence that big investors, sophisticated, wealthy investors, are starting to buy gold and buy it in large quantities.
Yeah.
And that is just saying that there's loss of confidence in paper money.
Yeah.
So I can't say how high gold's going to go, but I can say that gold will retain its purchasing power, and that's the most important thing investors need to keep in mind.
All right,
because paper is an abysmal failure in that regard.
Okay, what happens, though? The wrench in the works for gold and gold's rise, could it be when the dollar turns? I mean, some people are looking for that to happen when the Fed starts exiting in a concrete fashion sometime maybe early next year.
Yeah, and I really have a hard time seeing the Fed do that. You know, in a way, I wish the Fed would, because as an American, I hold dollars. I do better if the dollar is strong than if the dollar is weak. I don't export personally, so it's not in my advantage to see a weak dollar.
Yeah.
But yes, I think you're right. And we saw last fall the dollar get stronger and gold go down in nominal terms. But actually, when we had that shaky financial situation in the markets, gold got stronger versus almost everything else except paper. Gold got stronger compared to oil, copper, all kinds of materials, and almost everything else. So gold is really the thing to hold in either inflationary or deflationary, unstable periods of time under either event.
All right, Jay, pleasure talking to you, sir. Useful. Jay Taylor, President and CEO at Taylor Hard Money Associates, live out of New York.